Hey there everyone, this is Tom Vylord from Wall Street Value, and today we've got a quick tip to share with you, and this one's the earnings yield. If you're looking for a really good stock screener, I'd head on over to the site magicformulainvesting.com, and this was created by hedge fund manager Joel Greenblatt. He runs Goliath Capital, he's the founder of the Value Investors Club, and he's also an adjunct professor at Columbia University. So this stock screener sorts out companies on a scoring chart based on two metrics that he talks about in this book here, The Little Book That Beats the Market. And the two metrics are earnings yield, which we're going to talk about right now, and in our next video we'll talk about return on capital. So when you go to that site, enter the market capitalization or market cap, the screener is going to sort out the companies of that size based on the highest combined earnings yield and return on capital score. We find a company that has an earnings yield of 15 and a return on capital of 10, that's a combined score of 25. Now, if there's a company that has an earning yield of 20, it's obviously much better than company A, but their return on capital score is just 4, well, that has a score of 24. So it rates the companies based on the highest combined score of both of those two metrics. And I use this screener to get the idea to buy EBIX. So it had a high earnings yield, a high return on investment capital or return on capital. I put it through the other items on my checklist and I realized that this is a pretty good company and it was also undervalued at the time. So I bought it at 15, then it took a dip, went down to 12.50, I bought some more, and as of today, January 12th, the stock's at $81.65. Earnings yield is the earnings per share divided by the current stock price. So it's a very easy thing to figure out. And it's the inverse of the PE ratio, which is the price of the stock divided by the earnings. So money managers use this yield to compare to the 10-year Treasury yield, which is often looked at as the risk-free return. Click on this link right here from CNBC to find out what the current 10-year Treasury yield is. Earnings yield should be at least twice as high as the current 10-year Treasury yield. Otherwise, the risk of owning any stock or index for that matter is not worth the risk. So we want to see earnings yield preferably over 10%. Now the absolute minimum should be 2 times the 10-year Treasury yield, but when I put it on my checklist, I want to make sure it's over 10%. A higher earnings yield means the company is earning more relative to the price that we're paying to buy it. And that last point is so huge, and this is why the earnings yield is an important part of our checklist. We want to make sure the company is earning more relative to the price that we're paying to buy the stock. So that's it. Told you it was a quick one. So we'll talk about the other part of the equation, which is the return on capital, in our next video. So we're still signing people up for the 16-week stock investing and options trading class. If you want some more information, shoot me an email, tom@wallstreetvalue.com. And that's it for today. Thanks for tuning in.